Hi everyone, it's a daily 10-minute business and finance news wrap for this Thursday, the 29th of July. Now, Westpac today assuming the Sydney lockdown will last through to the end of September 2021 with the potential threat of it even being extended. Now, it says that in making its new forecasts for the economy, downgrading some of those predictions for economic growth, and it's calling on the Reserve Bank to take some immediate action. For more on that, I spoke earlier with its chief economist, Bill Evans. Bill, you're assuming that the Greater Sydney lockdown will last through to the end of September. How did you get to that assumption?
Ricardo, I don't think anyone really knows the answer to that, but we think it's reasonable that it'll certainly go a lot longer than the current guideline of the 28th of August. And I think another month will be necessary, and then we'd be looking for a staged freeing up over the course of October and into November.
If it does last through to September, what will be the economic impact both at a state and national level?
We're looking for a contraction of the state growth of 7.8% in the September quarter, which would channel into a 2.2% contraction in the nation over that quarter. But we are expecting to see quite a strong bounce back. So 3% growth nationally in the December quarter and 5.6% bounce back in New South Wales.
So what will that likely mean for jobs?
We're expecting to see around 200,000 jobs lost over that September quarter. But once again, quite a strong bounce back of around 185,000 jobs in the December quarter. So the unemployment rate will drift up to around 5.7% by September, but we would expect it then to come back down to around 4.8% by the end of the year.
So we won't see a technical recession, but will it feel like a recession, especially in Sydney?
I think it's going to feel very difficult in Sydney over the next couple of months. And of course, what we don't know is whether indeed we'll see the bounce back. You know, we think that's our central case, but of course with Delta, you can't be certain. We think that there'll be a lot more government support as we go on. I'm a very big supporter of the JobSaver initiatives that we saw today. I don't think we needed JobKeeper, and I think the government's on the right track with that and with the disaster payments. But I expect there'll be more money to support the economy and to eliminate any risk of major scarring that will allow us to get back on an even keel and with a very high level of vaccination by the end of the year, which will set the scene for a strong growth next year. We're expecting 4.2% next year and nearly 3% in the first half of the year.
We often hear about a rapid rebound once restrictions are eased. Is there a threat we won't see that speedy recovery this time around?
There's a risk of that happening. But I think the difference this time is that whilst we're dealing with Delta, which suggests that there could be bigger concerns, we're also going to be dealing with a rapid improvement in vaccination rates. I think the sort of the benefit of what we're seeing in New South Wales at the moment is that vaccine complacency and vaccine hesitancy is not going to restrain the demand for vaccines as we saw in the first half of the year. And on the supply side, governments, of course, are absolutely committed to lifting vaccine supply as quickly as possible. And I have no doubt that the governments are doing more deals in the background to try and lift particularly the Pfizer supply over the course of the next 6 months.
So now you're calling on the Reserve Bank to take some immediate action. How?
Well, I think the RBA has said they're prepared to be flexible on their policy to either lift or to reduce their purchases. And the flexibility would come from a major change in economic circumstances. Well, we're certainly seeing a major change in economic circumstances, seeing a contraction in the economy of around 2.2%. Now, I expect that the RBA board will be advised along similar lines to our forecast. And so they'll be confronted with the challenge of really quickly moving policy to adapt to the changed economic outlook. And we've seen them do that very successfully over the course of the last 12 months or so. And that's why I would expect them to respond again by actually lifting their purchases rather than cutting back the purchases that is their current guideline.
What kind of a message do you think that sends?
I think it would send a message that the RBA is prepared to move quickly when the economic circumstances change, that they have confidence in the effectiveness of their instrument. And that will give us confidence that we know that the government is going to be certainly boosting their spending, as they have already done, but we know that the RBA will be with them, as has been the case basically since COVID first emerged back in March last year.
Bill Evans there, the chief economist at Westpac. Despite all of that, the Australian share market rose today by 0.5%. For more, I spoke earlier with Angus Geddes from Fat Profits. As the market is up today, why?
Look, we've had a pretty strong run in the resources, running on the back of that very strong profit result from Rio Tinto, $12 billion in revenues and a bumper dividend for shareholders. So I think that really pretty much ignited the resources space, and it had a bit of a knock-on effect for the broader market.
I want to go into detail about resources in a few moments, but first, broadly, we heard from the US Federal Reserve overnight, pretty much steady as she goes, and I think there was almost a comment from the chairman saying, hey, we're not too worried about the COVID variant. Is that right?
Look, the Fed's got one eye on the COVID variant. They see that as a potential downside risk, but probably a smaller risk. They've definitely decided to keep the brake on monetary policy and not do anything with interest rate settings. So they're probably not going to be making any changes anytime soon.
As you mentioned, resource stocks doing well today. The major miners, Fortescue exceeded shipment guidance today. You mentioned that Rio Tinto profit number that came out late yesterday, and those huge dividend payouts for investors. BHP, Rio, Fortescue, are they all treated equally? And what about the future for iron ore prices?
So the first part of the question, BHP and Rio are the two largest bellwethers in the iron ore diversified resource space. So they're the two largest companies. Fortescue is quite a bit smaller, so it's valued slightly cheaper. Secondly, BHP and Rio have probably the best ore bodies in terms of iron ore grades. So Fortescue has sort of a slightly less high quality grade. And the third point is BHP and Rio both have diversified earnings streams from different commodities and energy, whereas Fortescue is just a pure play on the iron ores and the iron ore space.
Do you think that there is still more opportunities for investors in that space?
Look, my view is that the iron ore prices are going to remain quite elevated for some time. We're going to see the world continue to spend a lot of money on infrastructure, a lot of construction. It's picking up in the US with the infrastructure bills, also in Europe. So, look, I see iron ore prices remaining elevated for probably a number of years, and we're seeing a lot of broker upgrades come through on the major iron ore producers.
Wesfarmers has bid for API today, Australian Pharmaceutical Industries. It's been turned down. It's just one of many takeover offers in the market at the moment. What are you expecting to see in terms of merger and acquisition activity, and where from?
Look, I think the M&A activity is only going to go. It's only going to go higher. We've got record low interest rates, lots of liquidity sloshing around the global financial system, record low interest rates, private equity firms looking for ways to get a higher return on capital. So I think the M&A wave is only going to continue. And I think, what almost is beginning to stand out in the Australian market is the fact that the Australian dollar is lower versus the US dollar. So it's sort of rendering Australian targets as more attractive.
Angus Geddes there, CEO of Fat Profits.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice, and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.